Inflation is the increase in the price of goods and services over time. Remember how we often hear tales of how houses used to cost just a couple of £1,000s, or that a can of Coke used to be just 25p? That's inflation. The Bank of England targets inflation at 2% a year to preserve the value of our money. This is called its inflation target. Inflation has fluctuated a lot over the years, but for the purposes of this video, let's stick to 2.5%. You take an average weekly shop. It may have cost you £100 about 12 months ago, but now, due to the effect of our 2.5% inflation, it costs you £102.50. The longer the time frame, the greater the effect. Imagine £100 in 1977. It would only buy you £20 worth of goods and services today. Inflation is usually measured against the Consumer Prices Index and the Retail Prices Index. Both CPI and RPI measure the prices of hundreds of everyday items and services, from a loaf of bread to the hourly cost of a childminder, tracking how these prices change over time. RPI includes a range of costs which are not measured in CPI, for instance, mortgage interest payments and council tax. Depreciation on houses has a higher weighting, and the methodology differences are even more important. Inflation affects everyone and has a lot greater influence than just the cost of our weekly shopping trip or visit to the cinema. State benefits and pensions are linked to inflation, and it can even have a direct impact on people's incomes. Inflation is influenced by the amount of demand in the economy relative to the available supply of goods and services. In addition, the cost of imports can have a big impact, particularly the cost of energy and raw materials. When demand is high, prices tend to rise. This is sometimes explained as too much money chasing too few goods. For example, when a new computer game console comes to market, and everyone wants the latest version, its price is set at a premium due to high expected demand. Similarly, when governments want to boost the economy, they might start building new roads or factories. This creates more jobs, giving people more money to spend on more goods and services, thereby increasing demand. Quantitative easing, or QE, also has the same effect of increasing demand. QE is the process where the Bank of England buys government bonds to inject liquidity into the financial system to increase the money supply and encourage lending by banks. Inflation normally falls when there is a reduced demand for goods and services. As the job market slows down, people spend less money, leading to a reduction in the cost of houses and other consumer goods, for instance. If you buy a house for £100,000 and borrow £50,000 for the purchase, that is 50% of the purchase price. With the effects of high inflation over the next 5 years, the price of your house doubles. Your house is now worth £200,000, but you still only owe the £50,000 from the purchase. Effectively, your debt is now only 25% of the value of the house, not 50%. High inflation may be good for borrowers, but it's not good for cash savers. Inflation can decrease the real value of savings over time, and the amount you see in your bank account does not necessarily tell the full story of what your money is worth in real purchasing power terms. Inflation can be kept in check by ensuring that the growth in demand does not get ahead of the growth in what we can produce. So how is this done? This is where the Bank of England comes in and the setting of monetary policy. The Monetary Policy Committee controls the Bank of England interest rate, the cost of lending, which affects how much interest we earn on our savings and how much we pay on debts such as a mortgage. During periods of high inflation, the Bank of England will usually increase interest rates, so people spend less and save more. To maintain the real value of your savings, it's important to receive an interest or a return which matches inflation. Assuming an inflation rate of 2.5%, the £100 at the end of year 1 will need to earn £2.50 in order to maintain the same purchasing power. There are ways of preserving your savings from inflation by investing in products which offer you a real return, which is a return above cash or CPI. If you are not sure where to start, you might find it helpful to speak to a financial advisor. You can find one at unbiased.co.uk.